So interest rates are at their 20-month low. So we're currently in a market where we're seeing interest rates drastically drop, and I wanted to come on live and kind of talk about how interest rates are affecting home buyers, how interest rates are affecting or will affect homeowners. So when you have interest rates dropping ahead of the Federal Reserve dropping interest rates, we're starting to see more mortgage applications in terms of home buyers. We're starting to see more mortgage applications in terms of refinances as well. So for the home buyer, what it does is it allows for them to potentially qualify for more homes. The only way that they'll know if they qualify for more homes is if they put in a mortgage application with a loan officer, mortgage professional. Um, so by doing that, what I mean is if a home buyer has been approved for, let's say, 350, and they couldn't find anything in their price range, or the $350 a month, $350,000 monthly payment was too much for them. And now at that point, let's say they were pre-approved and interest rates were 6.75. And when they go to look or speak to a loan officer and get pre-approved now, the interest rates are, let's say, 5.75, even 6%. That's a drastic drop in the interest rate, and that will help them potentially qualify for more, barring anything has changed, meaning their income has not declined, their homeowners insurance quotes that they were looking at haven't gone up, taxes haven't gone up in their area. So all of those things play a factor into whether you can qualify for more. So qualifying for more, the interest rates are dropping. Housing prices have still remained the same in most parts of the country, right? Real estate is local. So what may happen in, Miami, Florida is even different than it would be in a Jacksonville, Florida, right? So you still want to get yourself prepared, because interest rates drop doesn't automatically mean you qualify either, right? You have to prepare yourself to become a homeowner and prepare to make sure you can qualify for a home or qualify or be able to afford the payment. I want you to understand that, don't sit back and try to time rate. You can't time rate. One of the biggest things that I'm hearing is a lot of people they said they want to wait to see what happens after the election. Over the course of the last 30 years, last 32 years, in terms of elections, that's 8 presidential elections, home prices have increased after the election. There's no magic pill in terms of the home prices, whether you're right wing, left wing, liberal, conservative, whatever party you vote for. And this is not a political, video, but they can't control housing prices going up or down. They can propose some incentives to help with housing in terms of um, Vice President Harris saying, "Hey, we're going to try to impose a $25,000 grant to first-time home buyers," which President Biden has been trying to implement since he's been into office. There's no guarantee that that $25,000, will come to fruition. So trying to time that and make sure that you can get it, that's kind of out of the realm right now, right? Even if she does become president, she still doesn't become president until sometime in January, and then she has to immediately enact that bill, and it has to be voted upon, and it's most likely, potentially going to get shut down. If it doesn't get shut down, then there's still some steps that you have to get to that part. In terms of interest rate, neither one controls the interest rate. There's a lot of, people saying, "Hey, well, I'm gonna see what rates do after the election." Neither one control it. The economy, inflation, jobs, all of that controls the interest rates that we may see. The other thing is, I want to educate my people also. You so right now, as mortgage companies, we're anticipating the Federal Reserve dropping interest rates, and when they drop interest rates, as I always say, there's not a direct correlation or effect to dropping interest rate, mortgage interest rates. As mortgage companies, we look at the market and we follow what the market is doing, treasury bonds, the Federal Reserve, what they're doing. And right now, rates are dropping now because we've had and we've factored in some rate cuts, right? Truth be told, when the Federal Reserve potentially cuts rates, interest rates could slightly go up a little bit, right? Or you may not see a change because they've already been factored into the interest rates now and the pricing of homes. So waiting to see or waiting for the Federal Reserve to drop the interest rate isn't necessarily going to help. If they drop it 0.25%, that doesn't mean that mortgage interest rates drop 0.25%. If they drop it an eighth or 0.5%, that doesn't necessarily mean that mortgage rates are going to drop. What you can do is pay attention to the market that's going on now and just prepare yourself. If you're not ready, then that's fine. But you want to get in position to figure out how you're going to be ready because you don't instantly or magically become ready because housing prices went down, or you don't instantly or magically become ready if you're not if interest rates go down. So that is how it affects home buyers. If interest rates go down, home when I mean, interest rates are going down, right? It helps home buyers be able to potentially qualify for more. So that's what you want to look at. If you're a current homeowner and you're like, hey, how can interest rates help us? It can help you save some money. You could potentially save money by refinancing out of your current interest rate into a lower interest rate. So if you purchased a home in the last 24 months and you didn't get a super low interest rate because you were using a builder or a preferred lender through a new construction builder that allow for you to get a super low rate, you're probably in position or could benefit from refinancing. If you did get a good rate with a builder, but it's a 2-1 buy down, a 1-1 buy down, and interest rates get to a certain point, it would make sense for you to refinance and lock in that lower rate. For example, I had someone reach out to me right now, their interest rate is 4.99. Next year, it will increase to 5.99. What does that mean to them? Their monthly payment goes up. However, if they can get a lower interest rate between now and when their rate goes up or right after their rate goes up, then that's going to help them save money in the long run. If you currently have a 7% interest rate and you're looking to refinance, I have a client now who has a 7% interest rate. I was able to quote her at 5.75. That saves her a couple $100 a month. It also saves her 1 month of paying her mortgage payment, which then allows for her to take that money and pay down some additional debt or to be able to save those funds so that she can do something else with them. So refinancing does help you, getting a lower rate helps you save money monthly. It also helps you, save money, of course, over the course of time from not paying that on that interest. But it also gives you a little time frame to a kind of reprieve of paying your mortgage payment, which you can use to do something else with it. I advise you if you're going to refinance and you're going to get I call it a free month available, I wouldn't blow that money. If your mortgage payment is normally $2,000, I wouldn't blow that $2,000. $2,000. I would do one of two things. But three, I would save it. I would use it to pay down on debt, or I would apply it to principal on my mortgage so you'll be paying down your mortgage and potentially pay your mortgage down faster. Hey guys, if you're out there and you have questions pertaining to what interest rates are doing, questions about purchasing a home, questions about refinancing your home, even an investment property, home equity line of credit, any questions that you have out there. This is impromptu, but I think it's a good time to discuss how interest rates dropping can affect you, how interest rates are going to affect the market, and what we could potentially see in the market if rates get to a specific point. If you're new to the channel and you have not subscribed, do me a huge favor and hit the subscribe button. Hit the subscribe button. If you are also new to the channel and you have not joined our Facebook group, we have an amazing Facebook group. The link will be below. You can join. There's 3 questions that you need to ask to get into the group. I want to make sure that I'm able to help you. The questions are to help you in terms of what you have come to the group for, and then the questions are to make sure that we're getting people who are interested in home ownership and not someone looking to spam or do something crazy in the group. The other thing is we have an amazing newsletter that we send out every week, twice a week. As of right now, we could see it increase, but it'll never be anything to spam you. It will always be great content about home ownership when we put out videos, if we're going live, Q&A sessions, if we're offering something special. That, those are things that we put out. The link to join the Facebook group will be below. The link to join the newsletter will be below. And as a gift from me to you for joining the newsletter, we will give you a free home buyer's guide to help you through your process or answer some questions through the process of purchasing a home. So you definitely want to join the Facebook group. You want to join the newsletter and get some amazing information. Again, if you're just joining the live and you want to know, hey, what the heck is Kevin talking about on a Saturday night? I'm talking about home ownership. I'm talking about how interest rates dropping can affect a home buyer, and how interest rates dropping will affect people who currently have homes but they like to refinance. How you doing, Brown Sugar? How are you? Again, if you have questions pertaining to home ownership, then let me know. My phone number, I'll put it in the chat. That's my direct line, how you can reach me. You can text me. I'm sorry, I keep saying but you want to make sure that you're in position. If you currently, so refinancing. How long do you have to be in your house or have ownership in your home before you can refinance? And it's 210 days from the day that you purchased your home. So if you purchased your home and you got an interest rate of, let's say, 6.25%, and interest rates drop next week to 5.5%, and you did an FHA, a VA, a USDA loan, or a conventional loan, you don't have the ability to refinance right away. You do have to have been in your home for at least 210 days, but you want to make sure that you pay attention to the market. You want to make sure that you keep your payments on time, and when that 200-day time frame elapses for you, then you want to make sure you're in position to refinance. Excuse me. No. So, refinancing does a couple of things. If you purchase within the last 7 months, even though you refinance, that does not necessarily mean. All right, I'll get my scheduling link put in the chat. Thanks. I'm gonna call you. Me and my husband are truck drivers, and we're ready. Awesome. Give me a call. Even better than potentially give me a call. The link, if you want to, if you would like to schedule an appointment with me, my appointment link will be below. You can click on it, schedule a time that's available for you and your spouse, or just you, and then that'll give us an opportunity to talk. In terms of, being prepared, or ready to move forward, just make sure that you start gathering information that makes the process smoother. Uh, two months of bank statements, 30 days of pay stubs. If you're self-employed as truck drivers and you're not W-2s, then we need your last 2 years of tax returns, federal tax returns, all pages. We need a copy of the unexpired driver's license. If you're self-employed, make sure you understand that even though we're getting, in this case, 23 and 22 tax returns, you want to make sure you also are working on a profit and loss statement. How much money have I made from year to date, from January 1st to September 14th, 2024? And then you want to make sure you have, some expenses that you utilize. So the profit and loss statement is okay. They don't have 2024 tax returns, but they do have a P&L statement, profit and loss statement, which shows that, hey, they're still making the same income or greater income than they were over their 2-year average. So we got some questions coming in. Uh, Evening, Blair. How much of a difference in the mortgage payment will there be with the current interest rates in comparison to months ago? Um, that's a great question, Blair. It so example, the young lady that I'm working with now, she purchased, her mortgage was uh she purchased for 260. Her principal balance is like 253. Her payment, principal, interest, taxes, insurance, and then her HOA. Well, not without her HOA. Her payment was like $2,240. Now she's dropping her payment. Um, her payment, she saves about 150, 160 bucks. So that's based off of her loan amount of 253. If it's a higher pricing point, you're going to save more. So the change in the interest rate is going to be different based upon how much your loan amount is. The higher the payment is, the higher the payment was, or the higher the loan amount is, the greater amount that you're going to save, because you're lowering the interest rate and it's taking more interest off of a higher monthly payment. So anywhere for her between 20 and 40, between 140, 160 bucks a month, right? There is one client that's looking to refinance, and she's only going to save about $60 a month, right? But she'd like to refinance to give her a reprieve on making her payment so she can use it to pay somewhere else. So always, paying your mortgage payment off, or paying your refinancing, or getting a free month to pay, could help you or save you from getting into a jam, because you can use that extra money to pay down on the debt. How low a rate? It depends. Um, it depends on a lot of factors. Depends on your credit score. Depends on your debt to income ratio. Depends on what type of product you're using, right? So conventional interest rate on a first primary residence, not first, but primary residence, is always going to be higher than FHA, VA, and USDA. If you have certain credit scores, if you got a 580 credit score, yes, you can get approved for FHA, VA, USDA, but you're not going to get a, super low interest rate. The the lowest I've quoted someone so far has been like 5.5 with one discount point. Discount point is equivalent to 1% of the sales price. Some people look at it as an origination point, so it's 1%. If it's $200,000 house, it's $2,000. So it just all depends. But interest. If you're under, I want you to understand this: the interest rate have decreased, but the biggest thing is, where are you? Am I using down payment assistance? Well, if you're using down payment assistance, the interest rate is typically going to be higher because they're going to have some say or control of what the interest rate is going to be. What's my credit score? If your credit score is on the lower side, and I'm gonna say below 640, and you're utilizing you're gonna max your purchasing power, and you're going to have a high debt to income ratio, your interest rate is typically going to be a little bit higher. Also, if you don't have money, meaning you just have enough for down payment and closing costs, and you don't have the ability to pay a little bit more to get a better rate with discount point, then you're going to be looking at a higher interest rate. It says, how do I do comparisons with lenders without affecting my credit scores? Is that possible? Um, Not really. And I'm gonna say not really because they're guessing, right? They're guessing what it could be. You don't necessarily potentially know what your accurate credit score is, because what you see on Credit Karma, Credit Wise, Credit Sesame isn't going to be what we pull. And then we don't have all the information. Certain price. So like for example, if you're looking at a house and you can get pre-approved for $250,000 house, and you've got a 640 credit score versus someone who has the same credit score, but they're looking to buy a $150,000 house. The person with a $150,000 house interest rate is going to be higher because of the pricing point. All of those things play into it. So could you get a comparison from lenders based off the information you are given? Probably. Would I do it? I would potentially do it, but I definitely want to give you a disclaimer of this is based off of what you're telling me, and it's because you can't lock me into saying, oh, well, you told me my rate was 5.75, but you told me that you had a 680, and it comes out that you got a 620. So, it's a way to do it, but I'm not going to say don't worry about your credit, but I think people are getting misconstrued that having a bunch of inquiries on your credit in terms of purchasing a home doesn't affect it. I think you're getting it mixed up with when you're looking to get some type of business credit or do something with investment property, some of those things you see online. But if you ask me, hey Kevin, what I've got a 680 credit score, I'm looking at $250,000 house, I'm looking to buy in, Atlanta, Georgia. What will my interest rate be? I'm a first time home buyer. I'm putting down 3.5% on FHA. What would the rate be? I could quote price it for you, but I wouldn't give you anything in writing because you haven't given me anything. That would be the only way. Some lenders do and some don't. Hopefully that answered your question, Patricia. No problem, Brown Sugar. I've been at the same job over 2 years. If I stay at the same job but get a new position for less pay from overnight shift to day shift, will that significantly affect my rate for approval? Depends on your debt and depends on how much a change in your income that would be. So example, let's say you made $25 an hour and you got 40 hours a week is what your new job would be. But you were working on your job and you were making $25 an hour plus shift differential. Let's say shift differential was $1.50 and you were working 40 hours a week, then we just don't count the $1.50 for shift differential. So it just gives you that amount. Now, how significant is it? It depends on your debt to income ratio. So let's say you qualify for $350,000 with that income you were getting on night shift, but you said, "Hey, I don't want to spend 350 because I don't want my mortgage payment to be, close to $3,000. I'm more comfortable with 2,300 dollars, and you're taking a pay cut, then you could probably still qualify for something in that price range of $2,300. But for you just kind of see what the comparison is. If you have pre-approval now, then you know what you were approved for, and then we could run those numbers and see what it would be and tell you what you would qualify for. Uh, am I able to assist in New York? Yes. I'm still able to assist in New York. If you want to schedule an appointment, my link will be below to schedule an appointment. Um, Also, if you guys are just joining the live, we're discussing, breaking news, interest rates. So they're actually the lowest they've been since February of 2023. So if you purchased in the last 2 years, last 24 months, you haven't gotten a super low rate from or a lower rate from a builder because you did new construction, then it would be a great time to take a look at, getting a quote to see what it looks like to refinance. If you were pre-approved in the last 2 years and you haven't purchased because housing prices haven't decreased and interest rates were higher, and now you're in a position to where, hey, rates are dropping, this home price may be closer to where I'm more comfortable for my monthly payment, it would be a good time to start the process. Because you start the process does not necessarily mean you have to finish going forward with it. There still may be some things that you need to do. You may need to pay some debt down, or you also may have to, you could get an idea, okay, interest rates are at 5.75 right now. If they drop to 5.25, that's a good sweet spot for me. And I think I'm good with that payment. What does that look like? So, it will, it's advantageous to get the process started, or more, even advantageous to kind of see where you are or get prepared so that when rates get to where your breaking point is, then you're in position and not waiting to see if you can qualify so you can take immediate action. Yes, I'm able to assist in Georgia. So, um, yep, I'm able to assist in Georgia. I'm actually in Georgia. So if you're interested if anyone on this call is interested in setting up an appointment with me, and I know I just said it, click on my link below. My goal is to make as many homeowners by the end of the year. Right now is a perfect time for you to start applying. It's a perfect time for you to prepare yourself so you can take advantage of the lower interest rates that are coming and that are already here. And also, if you apply now, you qualify, there's a likelihood that you can be in your home by Christmas, before Christmas, in time for Christmas, in time for Thanksgiving. Let me give you an example. Let's say you call me Monday, we set up an appointment, we have our consultation, you go to application. By Wednesday of next week, you have a pre-approval. I either connect you with one of my real estate partners, or you have a real estate agent that you're working with. You go out and you look for properties. Let's say you find a property that you want by the beginning of October, right? Beginning of October, you can get under contract, you have your inspections, you settle by the end of October or beginning of November, you can be in your house in time for Thanksgiving. But guess what? Your first payment, say you close on your mortgage in October. If you close in October, your first mortgage payment would be due in December. If you close in November, your first mortgage payment would be due January. So, it's a great time for you to start the process. Holidays are, I think my wife told me, got 123 days left in the year. Probably a little bit less than that now, but the year end is almost here. But interest rates dropping, opportunity for you to get into a house. If you start now, you could get into your house by Thanksgiving. Let's say you missed Thanksgiving because it took you a little while to find your home that you wanted. You can be in it by Christmas. Hey, you could be in it by New Year's, beginning of New Year or New Year's Eve to celebrate being into your house in the New Year. So it's a good time to start looking. Rates are, I do want to say that I don't think that rates are going to get to the threes or the fours like they were before, without you having to pay it down for a four. 3%, I'd be shocked if they were there. However, you just never know, but you always want to make sure in position, and you don't want to wait trying to time the market to see if they'll get there and lose out on potential houses that you could get. Let me kind of reset the room. We're discussing that interest rates are the lowest they've been since February of 2023. If you're just joining it live, you can drop your question below. I will answer it, whether it's pertaining to home ownership, where if you're a homeowner and you're looking to purchase, I mean, not purchase, but you're looking to refinance to lower your payment and save you some money. Even if I'm willing to take questions about investments. If you're looking to invest in the real estate and want to know what that looks like, I'm interested in that as well. And if you just got a general question because you don't know if you're ready for home ownership or you never considered it and you happen to hop on the live because you've seen the notification was scrolling through YouTube on a Saturday night, figuring out what to do. You can drop your questions below, and I will answer them to the best of my ability. Um, we also have an amazing Facebook group that I would love to see more people in. The link to join our Facebook group will be below. There are three questions that I need you to answer to get into the group. It helps me to be able to figure out what type of information you're looking for, so I can help you and help build my community. And then if you would love to get notifications or information pertaining to home ownership videos that I've released that you may have missed, or just steps and different things in the process, or great information on personal home refinancing, buying investment properties. Some things we may get into about credit, financial stuff. The link below will be to join my amazing newsletter. And as a gift from me to you for joining the newsletter, you'll get a free home buyer's guide that kind of helps you guide you through the process of home ownership along with me as the loan officer. Hey guys, if you're in this process, you're already pre-approved and you're looking to see if you got the best deal, I'm willing to take a look at fee sheets to see if there's something I can do better. Or if you're pre-approved with a different lender and you want a real estate referral, I can definitely give you that. Or if you want a second opinion, I'd be willing to give you that as well. Besides having to pay PMI, what are the downsides to putting 20% down on a home? Besides having to pay PMI, what's the downside to not putting 20% on the home? I don't think there is a downside to it. So private mortgage insurance is private mortgage insurance is on conventional financing. Mortgage insurance, MI, is on FHA financing. I just want to distinguish the difference between the two. Putting down 20%, you pay PMI. So let's say, Miss Patricia, that you guys are pre-approved for $400,000, and the house you're looking to buy is $400,000. And let's say your scores are 680, 700. On that $400,000 house, you're going to have to put a down payment of $80,000, and your mortgage insurance is most likely going to be somewhere around $200 and $210, right? Versus putting down 5% on that $40,000 and your PMI being $210. So is it worth bringing an additional, let's say, $60,000 to save $210 a month? So, that's really the only downside is you're out more money. It's in the house. I'd rather save that money to be able to make that additional payment or save the money in case something happens or you guys decide, hey, we don't want to be on the truck at all in December. Save that $60,000 so you can enjoy your house versus trying to save $210 and staying in on the truck. But no, not really any other downside. As long as you qualify for the mortgage with that amount of money, um, not really any other downsides and not putting down, 20%. It used to be that's the only way people could get financing back in the day, and that rule never really, that stigma never really went away. Even, when houses were $100,000 and you put 20% down, that's 20 grand. That was, that's the way to get a mortgage insurance. I don't think at that time as many mortgage insurance companies that were offering, competitive rates. And then things have changed over time, but nah, it's not really a downside to not putting down 20%. Can you talk about what we should be paying attention to on fee sheets? Are there any red flags we should be aware of? So when you're looking at a fee sheet, you want to see a few things. You want to see what, the so all companies are probably going to charge a underwriting and processing fee. For the underwriter gets that, the processor gets that. Then you're also going to be looking at whether a company charges origination points. Origination point is 1% of the sales price to originate the loan. Or discount points. Discount points are the same thing, 1% of the sales price in order to get an interest rate at a certain point. Depending on what state you're in, and I know where you're at, Blair, but depending on what state you're in, the fees are going to vary. There's going to be there's going to be tax prorations, there's going to be homeowners insurance, there's going to be escrowed homeowners insurance, there's going to be escrow property taxes. There's going to be carrier fees, that cost or wiring fees that cost the borrower to get funds wired to and fro different places. Um, if you had an appraisal and you go back, the appraiser has to go back out. They most likely will have a reinspection fee. Those run anywhere from 125 to 150,000. 150,000. I wish I would not buy a house if my reinspection fee was $150,000 or $150. Right? Credit report fees. The credit report cost companies and they have the ability to charge you back. So example, when you see a company, if you see a credit reporting fee on your fee sheet, don't be startled. They're only charging you what they were charged. Like companies aren't trying to make money off of credit reports. Like, credit reports cost anywhere from 50 to, 50 to 100 some dollars, depending on if you, depending on what you did. If you had multiple credit reports pulled through the company, they're just looking to get reimbursed back for it. And then I had someone say, well, that's the cost of doing business. It is. And some companies kind of hide that and just charge higher fees somewhere else. Um, depending on what state you're in, surveying, any red flags, not really. Um, you know, since 2010, mortgage companies have been highly regulated, highly scrutinized as to what they can charge and what they can't charge. And they do, and most of them do a great job of making sure the borrowers only charge what they're going to be charged. Um, when you get your first PC, you may see charges that don't necessarily not gonna say make sense, but you're like, why is this here? Because they have to disclose certain things in the beginning in case they have to charge it. So, example, the re-inspection fee for the appraiser. If that's not on that disclosure fee when you do it, and then they have to re-inspect, the mortgage company has to eat that cost. So that's the reason why they try to disclose when the fee sheet goes out in the beginning or you get it, it's a little bit higher than what closing is going to be because we don't know what we have to deal with going along, down the middle. Meaning credit report fee may be $50 so far, but we put $100 because we know your credit report is going to expire by the time you get under contract and get ready to close. So we collect that in that fee. In terms of red flags, the biggest thing probably would be seeing how many discount points your lender is charging you to get that interest rate. The better the score and the higher the rate, the lower the discount point should be, if that makes sense. The lower the score and then the higher the rate, the discount points are going to be higher as well. Be higher, not higher as well. But just I guess charging origination, or seeing what discount points are would be the biggest thing. Because if the rate sounds too good to be true, then it probably is. Like, you can get a lower. Like for instance, I had somebody compete against me. At the time, the person's rate was 6.25% is what I could get them. Another lender priced them at 5.75%. My 6.25% wasn't, I think it was costing them like $340. That 5.75% was costing them $5,000. It's a big difference. It's a big difference. That's $5,000 that the person either had to come up with or that came out of their refinancing. So it just kind of all depends. But those are the things you would look at. Okay, this is the rate. What does it cost me to get the rate? Why would it cost me to get that point? Hopefully I answered your question, Blair. Thank you. Wow, guys, I'm surprised. I didn't even advertise this. I just kind of jumped on impromptu to see who would show up. Again, to reset the room, we're talking about interest rates being lower at the lowest they've been in the last 20 months. What you can expect as a home buyer, how does the lower interest rates affect your purchasing power? And as a current home owner, what does that mean for you in terms of being able to refinance or save money or lower your rate? Or something else I hadn't talked about was actually refinancing and pulling cash out. That'll help, with you lowering the rate. You can potentially pull cash out or do some debt consolidation. Yes, okay, let's say your payment went up $200, but you were able to save $500 a month because you paid some debt. That makes sense to me. My realtor sent me 3 lenders to call. Should I be skeptical that these lenders will have my best interest at heart? Nah, I wouldn't. I wouldn't say that you should be skeptical. I don't know the lenders, so it just depends. So agents give you three numbers to call 3 different lenders, typically because each lender could do something different. One may offer a product a product that another lender doesn't offer. And the other thing is they don't want to be on the hook, right? They don't want to say you to say, hey, Susie, you refer me to Bob and he's not doing his job. They don't want to hear that or be on the hook. Or they also, do it to see how you can potentially get the best deal, and who offers what. I wouldn't say I would be skeptical, but I would make sure in looking at all 3, that you're comparing apples to apples and oranges to oranges, right? One person gives you, if all 3 of them qualify you for FHA, and you qualify for the same thing through FHA, you're still probably going to have different amounts from all three because each company does something different, right? Um, for instance, with us, I can close pretty quickly. Um, if that helps wins the deal. That may cost a little more um, in terms of fee, but it wins you the deal. Not necessarily say I'm higher, but it just kind of depends on the deal. But no, I wouldn't necessarily be skeptical of the three lenders. I would love to be one of the three lenders or the fourth to see how I can help you and your husband purchase a home. What's going on? Um, Also, you want to make sure that you're comparing um, the fee sheet. Going with the lowest rate does not always mean you're getting the best deal. If the fees are higher, if the service is not good, if they can't get the job done, then it doesn't help. So I had a young lady who was referred to me, and the lender that she was initially referred to pre-approved her, quoted her rate, but then during the pre-approval process, actually she went under contract. He couldn't approve her because he pre-approval was wrong in the beginning, right? She came to me, and when I quoted her the rate, it was higher than what she expected because it's a different type of loan. And her words to me was, "Well, he said I could get a 6 point, I think it was like 6.25, no 6.625 interest rate." And I said, "You're right, but he can't do the deal. So he can quote you a 5.25, and you won't get it because he can't close the deal." So, getting quoted a rate and the person not being able to do the deal for whatever reason, it could cost you more. Now, she eventually ended up getting a different rate, but I had more information at the time. So when she was trying to get the 6.25 interest rate, it was for a certain kind of program that she did not qualify for. So you just make sure when you're looking at those things, you're comparing. And if you have questions, ask the lender, "Hey, why is my rate this? Why am I qualified for this? Do I not qualify for conventional?" And just kind of get some information from each one of them. Shameless plug. If you are looking to interview with three different lenders, and you're getting information with your realtors, and you're also going through the process of home ownership, my home ownership journal is amazing. You can go through it. All those conversations that we just talked about and questions that you asked me in terms of taking notes, getting information from your realtor, getting information from your lender. You can put all that information in this book instead of putting it in a regular notebook or putting it on a piece of paper, the MLS sheet that that your realtor gives you. You can go through and put notes. The other thing is you can go through and journal your whole process. It has information on your budget, has information on important documentation you need. It has information on your credit. It's got information on, it's got plenty of note pages in here where you can put information on houses, the houses you've looked at. It's got information in here to take notes, like I said, from your lender, notes from your realtor, whoever your team's involved, from your loan officer to home inspectors to real estate agents, um, to attorneys, like all that information. The link to be able to purchase this will be below. But it's a great place, to put in your notes so you don't have to keep going back and forth trying to figure out, hey, where's this information I wrote down? I know I wrote something down, or what did my loan officer say about why my rate is this or that? Thank you, Patricia. Hopefully I win that spot. Um, Again, guys, if you were out there, you're new to the channel, hit the subscribe button for me If you're not new and you're watching it and you like the information I'm giving out, do me a huge favor and give me a thumbs up. I'll probably be on for a few more minutes, but I appreciate you guys jumping on a Saturday night with me. Um, so again, we're talking about interest rates being the lowest they've been in 20 months. What does that mean? That means the market is improving in terms of interest rate wise. Housing prices, depending on what part of the country you're in, still have not seen a major adjustment. Something I'm gonna end this too soon, right? But I want to end it talking about this to kind of get you thinking. While we're all waiting for interest rates to drop, a few things are probably going to happen. There's going to be more people in the market looking because more people qualify. What does that mean? That means your normal turn times with mortgage companies may increase because they're not staffed to take on the influx of business that we're going to potentially get. Potentially get meaning more homeowners, so probably more contracts, lower rates, more refinances. Those are the same staff members who are refinancing and doing purchase contracts. When you're refinancing and you have purchase contracts, most of the time the purchase contracts get precedence over the refinance simply because the refinance doesn't have a date on it. The purchase contract is somewhere probably between, let's say, 21 and 30 days. So be mindful of that. The other thing is now, instead of you putting in an offer and it being just you or two other people, you might have five other people putting in offers, and where the seller would, prior to the last 2-3 months, be able to offer some closing cost assistance or quite a bit, they may not have to now, because now instead of it just being one offer and them considering it, they could take the highest and best out of five offers. So those are things you want to consider when purchasing a home. You also want to make sure that you're ready to act quickly in terms of response time to your lender. If your lender is, if you're under contract and your lender needs documents, you want to make sure that you get it to them as fast as possible. Speed typically wins in transactions. And if you're like, for instance, if a person puts in documentation with me and they're slow getting me what I need, then I'm going to ask for more time for closing, because it's going to be like that in the process. It's just the way it is, right? If a person is quick, gets documentation right away, then I'm going to ask for a shorter period of time because I feel confident that they can get it done as fast as we need it to, based off of the way they send in documents. Again, you want to make sure you have your documents ready and available via PDF, where you can scan an email or send them in. No screenshot, no pictures of the screen, no pictures of the document. PDF. Why? Because the underwriters want to be able to take a look at that document, and they don't want to see your bed sheets or your foot or your toe or the car steering wheel in the picture, right? So make sure you have your documents prepared for you. Guys, we got like 7 more minutes and then I'm going to jump. If you have any questions pertaining to home ownership, refinancing, investment properties, scenarios that you're in, scenarios that you've been through, let me know. And also do me a favor. Since you jumped on, were you notified that I went live? Were you notified via Facebook, or were you notified via YouTube saying, "Hey, that the People's Lender is going live"? If somebody could give me an answer in the chat, that would be helpful. And for those of you out here who are not asking any questions, if you want to ask some personal questions, the link to schedule a consultation with me is below, along with my Facebook group, along with my newsletter. I put my phone number out there on the in the chat, so you can reach me. If you got a quick question and you want to text me, then you can text me as well. All right, notify YouTube. Awesome. Are properties current taxes or expected taxes for next year calculated into the mortgage payment? If it's not new construction, it's current taxes. Um, if it's next year's increased taxes, if the tax bill has not been paid yet, then it's current. If it's been paid, then it's probably going to be new. And if you're buying new construction, you want to make sure that they calculate your taxes properly. The reason why I say that is because I'm seeing people who purchase new construction, they've got taxes of one thing, and then the next year, one lady said her taxes went up $500 because they did not take out the right amount on her taxes. Um, so just be careful. But it's like right now in Georgia, they're collecting the taxes for this year. They're due November 1st, sometime in November, so they're collecting the taxes. We ran into So I ran into two separate issues earlier this year in the summer, right? In Maryland, we collected the current taxes, but we had to escrow for the new tax bill because it was out. So that monthly escrow amount is going to be different. In terms of the taxes, what was it, Maryland? And then in Illinois, they get taxed in arrears. So they get a credit. But you know that in a year your taxes are going to change because they adjust them in arrears. So, this year's taxes will be done next year. So be mindful of that. Don't you so you don't have any type of surprises where it's like, oh, my payment went up. And since we're talking about payments are going up. Homeowners insurance are increasing, property taxes increasing everywhere, and make sure you budget for that. You don't know what it's going to be, but you just want to make sure you don't overspend. Um, if you want more information on uh, if you want more information on or some help or some tips on budgeting, finances on the rise, it's someone that you can talk to. Friend of mine, Shannon Payton. Uh, she can help you with getting your finances in straight in terms of budgeting and preparing. She's excellent at it, and sometimes I have questions for my clients, and I send clients to her as well. So definitely, you want to make sure you're on a budget because things are going to change. Because now you're the homeowner. Now you are the person that fixes the toilet, cuts the grass, maintains the lawn, fix the refrigerator if something breaks. So just make sure that you're budgeting for those changes in homeownership. Well, cool. If there aren't any more questions, we're going to end this live. But again, if you're watching the replay, make sure you hit the thumbs up button. If you've got questions, drop it in the chat below. Take a look in the description below to join the Facebook group, the newsletter, or to contact me for a consultation. Also, do me a favor, search through my page and see what topics you may be interested in. Also, if you are new to the channel, hit the subscribe notification, give me a thumbs up. And if there aren't any more questions, I'm going to end this live. And I see I got a question. What is the best way to compare lenders? Jeez, that's a good question. One would be knowledge. One would be knowledge. Like, how knowledgeable is my lender? Again, why would I worry about my lender's knowledge? Because even though they pre-approved you, how solid is the pre-approval? So I would compare knowledge. I would ask questions to see what they know. I would, depending on where the referral came from. If it came from your real estate agent, then ask them, hey, if your real estate agent gave you 3 referrals, like they gave Miss Patricia, ask them if you were doing your personal home, which one would you use and why? In terms of if I'm one of the loan officers that you're interviewing, take a look at my videos and see, I'm not a hard salesman. I provide honest information. I give you feedback. If I can help you, I will. If I can't, I'll tell you. If you need help and you're not in position, I'm going to let you know, what you can do to get in position. Also, I don't know everything. If I have to find, if it's something I don't know, I have resources where I can find the answer. I'm pretty well versed from first-time home buyers to down payment assistance programs to second homes, investment properties, low credit scores with very little money, high credit scores with very little money, high credit scores with money, low credit scores with money. Like, I'm pretty versed. When I got into the mortgage business, I moved to a state that I didn't know. I knew people here, but I didn't know people that were buying here, right? So I moved to an area where I didn't know anyone, and I went through a lot of credit challenged people with very little money, and that helped me build my skills. I made a lot of mistakes along the way, but it's helped me to be able to know my mortgage guidelines and different programs. And I have the ability to um, problem solve. As loan officers, we're problem solvers. If a person can't go conventional like they thought they could, or for some reason they're a veteran and they can't use their VA, we'll figure out why. And if VA is not the option for them, what can they use? Is it FHA? Can they do USDA? Why would I use FHA over USDA? So just questioning them, that would be the best way to compare lenders. Hopefully I answered your question. I feel like it's a tough way to answer it, but knowledge and where you got your referral from. I will tell you that if you interview them, just like ask them questions that you would ask, like you would ask me on the live, pertaining to your situation. I will say, if you're looking at an online lender, like one of the 1-800 numbers, you've got a call center. You don't necessarily have a dedicated loan officer. If you're looking at your bank, you've got a banker, you've got a loan officer who does. The bank's main job is to bring in money. So their top business and most profitable business is banking and bringing in deposits and loaning out the deposits. The mortgage is just a service that they offer to people. Because it's your bank and you might put every dollar you have for the last 50 years in there, doesn't mean they're going to approve your loan. Credit unions offer great rates, they offer great products, but they're stringent on their guidelines and their debt to income ratio is a little lower. A mortgage company, who that's all they do is mortgages, they're trying to figure out how to get this person to a mortgage and how resourceful they are. So it just kind of all depends, but just ask questions. All right, guys, this has been real. This hour went by quickly. I wasn't sure how many people were going to pop on. Again, contact information below. Thank you for your time. If you got questions after this live, you can connect with me. You can connect with me by scheduling an appointment, or you can ask your questions below. I'm Kevin Jefferson, the People's Lender. Have a great night.